Today's tech news moves fast, but understanding it shouldn't be hard. That's why Snarful Solutions Group brings you Connecting the Dots, where we break down what's happening in tech and why it matters to you. Now, let's dive in with your hosts.
Welcome to Connecting the Dots. I'm Alex.
And I'm Morgan. Great to be with you today.
Happy Monday, everyone. It is September 8th, 2025. Hope you had a good weekend and are ready to start the week.
Definitely ready. Before we jump into our main story, should we do a quick check on the weather and markets?
Let's do it. Looks like some rush weather potentially down south today. Severe thunderstorms firing up in the southern plains, western Kansas, northwest Oklahoma, the panhandles. Could see some hail, damaging winds.
Oof, yeah. Stay safe down there. But good news for the eastern U.S. and mid-south. Looks cooler and clearer for you folks.
And right here in sunny Sacramento, looking pretty nice. High of 83 Fahrenheit today. Can't complain.
Not at all. All right, markets on Friday. The Dow closed at 45,321.90 NIA, down about 108 points, so minus 0.24% for the day and the week.
And the S&P 500, pretty flat, right?
Yeah, very flat. Closed at 6,496.10, down just under 2 points, so minus 0.03%. Basically unchanged.
But Bitcoin, showing some life again.
It is. Closed at 112,221.2. That's up almost 1% for the day, just over 1,000 points, and it's up about 2.73% since the 1st of September.
Interesting divergence there. Okay, one more crucial update. The Giants?
Oh, don't remind me. Yeah. Lost to the Cardinals yesterday, September 7th. Tight game, 3-4.
Oof, tough loss. Looks like Sonny Gray got the win for St. Louis, and their guy Nathan Church had a couple of hits. Oh, well.
Yeah, tough one. Okay, let's pivot to our main focus today, the Morning Star, our Snarful Tech article report. We've got three big stories connecting finance and tech.
Right. These aren't just abstract tech news items. We want to connect the dots for you, show how this stuff actually impacts businesses, professionals, maybe even your own wallet.
Exactly. So first up, Rainforest. It's an Atlanta-based startup, and they just pulled in a pretty significant $29 million in Series B funding.
29 million. That brings our total to what? Over 50 million since 2022?
Yeah, $57.5 million total. So investors like Matrix Partners, Infinity Ventures, Excel, Tech Square Ventures, they're clearly seeing something they like.
Okay, so what's the magic? What does Rainforest actually do?
Well, they're in the payment space. They call themselves a payments as a service provider. But the key thing is how they do it. They embed payment processing directly into other software platforms.
Embedded payments. We hear that term a lot. Can you break that down? Like, give us an example.
Sure. Think about software for a specific industry. Like maybe your local gym uses an app for booking classes and memberships.
All right.
Or maybe a contractor uses special software for scheduling jobs and sending invoices. Rainforest helps that software company handle the payments seamlessly within their own app or platform.
Okay. So instead of the gym needing a separate payment system or the contractor sending you to, I don't know, PayPal, it all just happens inside the software they're already using.
Exactly. It's aimed particularly at what's called vertical SaaS, software built for one specific industry, like healthcare, home services, education, things like that.
And why is that such a big deal? Don't companies like Stripe or Adyen already do similar things?
Well, that's Rainforest's main argument. Their CEO, Joshua Silver, says they are, quote, purpose-built for these software platforms. He argues that the big players like Stripe, Adyen, FIS, Fiserv, they started by serving individual merchants first.
Okay.
And then they kind of retrofitted their systems to work for software platforms. Rainforest says, nope, we started with the platform in mind.
So what difference does that make in practice?
It means they focus on things platforms really care about, like detailed reporting on residuals, the cut the platform gets from the payments, and managing lots of different merchants under one umbrella, things that might be secondary for the bigger, more general players.
Interesting angle. So it's not just about making payments easy, it's about making the business of payments easy for the software company itself.
Precisely. And it's a huge value proposition for those SaaS companies. They can apparently increase their revenue per customer by like 2x to 5x just by adding these embedded finance features.
Wow, 2 to 5 times. So they could end up making more money from the payments than from their actual software subscription.
Potentially, yeah. It turns payments from just a necessity, maybe even a cost center, into a major profit driver. And for the end customer, like you paying your gym or your contractor, it just feels smoother, more integrated, less hassle.
Makes sense. So how are they doing? Is this strategy working?
Apparently so. They mentioned 10x growth in annual recurring revenue just since June 2024. They're processing billions in live volume now.
10 times growth. That's explosive.
It really is. And they're planning to hire more people, expand into Canada, and add new features like tap to phone, letting businesses use smartphones as payment terminals.
And they're using AI too, right, for fraud detection.
Yeah, they mentioned using AI in their risk management, which, is pretty essential when you're handling billions of dollars. You gotta stay ahead of the fraudsters.
No kidding. It just shows you this embedded finance market is absolutely enormous. What were the projections? Something like $7 trillion by 2026?
Yeah, up from maybe $2.6 trillion back in 2021. It's massive growth. Even with giants like Stripe around, there's clearly still room for focused players like Rainforest to carve out a big niche.
It really hammers home how fundamental payments are and how much innovation is still happening under the hood. Okay, so that's payments becoming embedded, almost invisible. What about the actual assets being traded?
Well, that brings us nicely to our second story from the Morning Star. This one involves Nasdaq.
Nasdaq, the exchange itself, what are they up to?
They've filed a pretty bold proposal with the SEC, the Securities and Exchange Commission. They want to allow the trading of tokenized securities on their main market.
Tokenized securities, like stocks and ETFs, but on a blockchain.
Essentially, yes. Taking traditional assets like a share of Apple stock or an S&P 500 ETF and creating a digital token that represents ownership of that asset on a blockchain.
Okay, hold on. Let's unpack tokenization for everyone. Why is this significant? Why turn a regular stock into a token?
Right. So tokenization just means creating that digital representation. Think of it like getting a digital deed for a share instead of just an entry in a broker's database. The significance. Well, if the SEC approves this, it'd be the first time tokenized securities could trade on a major U.S. exchange. It's a huge step in bridging traditional finance TradFi with the world of blockchain and digital assets.
Wow, okay. So how would this actually work for, say, you or me if we wanted to buy some tokenized shares? Would it feel different?
Nasdaq says for the investor buying or selling, the process wouldn't really change much up front. Orders would be routed, priced, monitored, reported just like normal shares. The difference happens at settlement, the final step where the ownership officially changes hands. Instead of the traditional process, it would settle using the token on a blockchain.
And what about investor protection? Are these tokens the same as holding the actual stock?
That's the absolute crucial point. Nasdaq and folks at the SEC like Commissioner Hester Pierce have been very clear. These tokenized securities must carry the exact same rights and privileges as the traditional version. Pierce famously said, tokenized securities are still securities. You own the same thing, just represented differently.
That's good to hear. So what are the potential benefits then? Faster settlement.
That's one big potential benefit, yeah. Proponents argue it could make settlement much faster, more efficient, maybe eventually even instant, instead of taking a day or two like now. It could also improve overall liquidity in the system.
Are there potential downsides? New risks we should think about. Putting everything on a blockchain. Does that open doors for different kinds of problems like cyber attacks or bugs in the code?
That's definitely a valid concern. You introduce elements like smart contract risk, potential vulnerabilities in the blockchain itself, and fixing errors on an immutable ledger can be tricky. That's the trade-off you explore with new tech. But the really exciting potential, I think, goes beyond just faster settlement. Imagine being able to easily buy and sell fractions of things that are currently hard to trade, like a piece of commercial real estate, or maybe even a stake in a private company. Tokenization could, theoretically, make ownership of those kinds of assets much more accessible.
Right, the whole digital ownership of everything idea, that could really change how people invest and build wealth, couldn't it?
Yeah.
Making illiquid stuff liquid.
It really could. And Nasdaq isn't doing this in a vacuum. They noted that some platforms over in Europe are already offering tokenized versions of U.S. stocks, maybe sometimes without actually holding the underlying shares properly.
So this is partly about setting a regulated above-board standard here in the U.S. to compete with that.
Exactly. Create a trusted, equivalent way to do it within the established U.S. market structure. Now, don't expect this tomorrow. Nasdaq thinks the first token-settled trades might happen maybe late Q3 2026.
2026. Okay, so still a ways off. What's the holdup?
Infrastructure needs to be built primarily by the DTC, the Depository Trust Company. They're the ones who handle the settlement for almost all U.S. stock trades currently. They need to develop the plumbing to handle token-based settlement.
Got it. So a major step towards digital assets, but the groundwork still needs laying. It definitely feels like the direction things are heading, though. Okay, let's move to our third story, which also ties into this theme of crypto becoming more mainstream in finance.
Right. This one's about CoinShares. They're a big European crypto asset manager based in Jersey, and they're planning to go public here in the U.S.
Going public in the U.S., how are they doing that?
Through a merger with a SPAC, a special purpose acquisition company called Vine Hill Capital Investment Corp., which is already listed on Nasdaq. The deal values CoinShares at about $1.2 billion and should close by the end of this year, 2025.
Okay, CoinShares. How big are they? What do they manage?
They're pretty substantial. They manage around $10 billion in assets. They offer 32 different crypto ETPs, exchange-traded products, things tracking Bitcoin, Ether, Solana, other tokens. They're actually the fourth largest provider of these digital asset ETPs globally.
10 billion under management.
Wow.
So why the move to the U.S. market now? What's the driver?
Well, their CEO, Jean-Marie Margetti, called it a decisive inflection point. He pointed specifically to increasing regulatory clarity here in the U.S. for digital assets.
Regulation again. So the U.S. is becoming more attractive from a rules perspective.
It seems that way, at least in the view of CoinShares. Margetti believes getting a U.S. listing will, quote, reinforce credibility and expand reach. It really underscores how important the U.S. market and its regulatory environment are becoming for global crypto firms.
That's interesting because you hear conflicting things sometimes. Weren't there reports like from PwC saying some traditional funds were maybe thinking of leaving the U.S. because of regulatory uncertainty in the past?
Exactly. Yeah. Which makes this move by a major crypto native firm like CoinShares even more significant. It suggests a potential shift, maybe that the regulatory picture is becoming clearer or at least predictable enough for major players to commit to a U.S. listing. It might even pressure other regions to clarify their own rules so they don't lose out.
Sort of a follow the clarity effect, maybe. So what does this mean for U.S. investors?
Well, more access, essentially. Access to crypto investment products from a pretty successful established manager. They mentioned their assets have grown over 200% in just the last 2 years.
100% growth.
Impressive.
And they're not just listing the parent company, they're also setting up a U.S. hedge fund unit that'll be for qualified investors offering actively managed strategies to try and capitalize on crypto's, volatility.
So offering different ways to play the crypto market, it really does feel like another step in validating crypto as a serious asset class, even with all its ups and downs.
And they're profitable too, right?
Very. They reported a 76% adjusted EBITDA margin for the first half of this year.
76% EBITDA margin. For listeners, EBITDA is earnings before interest, taxes, depreciation, and amortization. It basically shows how much cash profit a company makes from its core operations. 76% is, well, it's incredibly high. Shows a very efficient business.
It really does. These aren't just hobby projects. They're serious, profitable businesses being built in the digital asset space.
All right, fascinating stuff. That wraps up our Morningstar report for today. 3 really key stories showing how tech is fundamentally rewiring finance.
Yeah, just to quickly recap, we had Rainforest, the embedded payments provider, securing major funding by focusing specifically on vertical SaaS platforms, really changing their economics.
Then Nasdaq's big move proposing to list tokenized securities on its main exchange, a potential game changer for how assets are owned and traded, bringing blockchain closer to the mainstream.
And finally, CoinShares, the major European crypto manager, coming to the U.S. public market via a SPAC, signaling growing confidence in the U.S. regulatory scene and giving investors more access.
All 3 really highlight this deep integration happening between tech and finance. It's changing how businesses operate, how money moves, and ultimately how you interact with financial services every day. Makes you wonder what's next, doesn't it? As everything gets digitized, what new kinds of value or ownership might pop up? It's
a space to watch, for sure. Constant evolution.
We're here to help at Snarful, so reach out on our website if you have any more questions.
That's a wrap on today's top stories. Remember, tech doesn't have to be complicated, and we're here to help connect the dots. If you've got questions or want to learn more, visit us at snarful.com. Thanks for listening, and we'll catch you next time.